So, you've done the hard part. You've saved up your first real chunk of money. Maybe it's $10,000, maybe it's $50,000. You're ready to make it grow, but then you hit the biggest question in investing. Do you buy property or do you play the stock market? Now, most people will tell you to just pull up a chart of historical returns and call it a day. That's a huge mistake. What feels like the smartest investment isn't always what builds real wealth. The answer actually comes down to one key thing that most beginners don't even think about, and it has nothing to do with the market itself. Stick around because by the end of this, you'll know exactly which path makes more sense for someone just starting out in the USA. Point 1. Defining the investments. First, let's get on the same page. When I say investing in stocks, I'm not talking about gambling on the next meme stock. For a beginner, the smartest, sanest path is buying a low-cost S&P 500 index fund. This basically lets you on a tiny slice of the 500 biggest companies in America all in one go. Instant diversification. And when I say investing in property, I mean buying a physical house or condo to rent out. This is not a passive gig. You're the landlord, which means you're the one getting the calls about leaky faucets. Point 2. The battle of returns. If you just look at the scoreboard, the stock market looks like the clear winner. The S&P 500 has historically delivered an annual return of around 10%. On the other hand, residential real estate in the US tends to appreciate about 4 to 6% per year on average. But if it were that simple, this would be a very short video. Property has a secret weapon, a financial concept that can juice your returns like nothing else. Point 3. The superpower of property. Leverage. That superpower is called leverage. Here's how it works. When you buy stocks, a $50,000 investment gets you exactly $50,000 worth of stock. Simple. But with property, that same $50,000 can be used as a 20% down payment to take control of a $250,000 house. You're using the bank's money for the other 80%. Now, if that $250,000 house appreciates by a modest 5%, its value jumps by $12,500. But wait, you only put in $50,000 of your own cash. That means you just made a 25% return on your investment. And that's not even counting any rental income. This is how you hear stories about people building fortunes in real estate. It's a powerful, powerful tool, but it also magnifies your risk. And this is where the dream of becoming a real estate mogul gets a dose of reality. Property is expensive to get into and expensive to maintain. You don't just need the down payment, you need an extra 4 to 6% for closing costs. And the expenses don't stop there. You've got maintenance, surprise repairs, property taxes, and insurance all eating into your profits. And it is not passive income. Being a landlord is a part-time job you didn't apply for. You're screening tenants, fixing toilets, and dealing with vacancies. Stocks, on the other hand, they are the definition of low effort. You can start with $100. Transaction fees are basically zero at most brokerages. And once you buy that index fund, you're done. You can go to the beach. It's a truly passive way to build wealth. If this breakdown is helping clear things up, do me a quick favor and hit that subscribe button. We're all about making this complex money stuff simple so you can build wealth without the headaches. Point 5. Risk and liquidity. Every investment has risk. The stock market is famous for its volatility. Watching your portfolio drop 20% is terrifying, no question. But the trade-off is liquidity. If you need cash, you can sell your stocks and have money in your bank account in about a day thanks to T+1 settlement. Property is pretty much the exact opposite. On the surface, it feels safer because you don't see the value swinging wildly every day, but it is profoundly illiquid. Selling a house can take months. If you have an emergency and need cash fast, you're stuck. Your entire investment is also tied up in one asset, in one neighborhood. What happens if the local economy takes a hit or you get a nightmare tenant? When you're just starting, that's a massive risk to take on a single investment. So what's the final verdict? For most beginners in the US, the answer is pretty clear. Start with the stock market. The ridiculously low cost to get started, the instant diversification, the high liquidity, and the truly passive nature of index fund investing make it the most logical and accessible path to begin building wealth. Property and the incredible power of leverage are amazing moves, but think of them as an advanced move. They're better suited for when you have more money, more experience, and frankly, more time for the hands-on work it requires. But here's the good news. You don't have to choose just one forever. You can actually get exposure to real estate through the stock market by buying REITs, real estate investment trusts. It's like getting a piece of the property market, but with the ease and liquidity of buying a stock. Ultimately, the best strategy is the one that fits your life and your goals. The most important thing is just to get started.